So today's video is going to be all about the MambaFX strategy. Everything that I've learned from being in his boot camp, to taking his course, to watching every video that he's ever done on trading. Also, I'm going to be adding my own touch, dropping some gems that I think have improved the strategy for me anyway. So hopefully it can improve it for you, because there's a lot of fake outs in this strategy and people don't really know how to deal with it. But if you're new, then welcome. And if you've already subbed up, you know that I salute you every time. I told you 2025 is going to be our year. So get your coffees, get your Red Bulls, get your pens, your pads, iPads, whatever it is that you need to take notes and really let it sink in. So part one, we're going to be talking about overall direction. Basically, market structure, your bias, which way you think price is likely to go on the New York Open when we're trading things like NAS and US30. Because even though we're trading breakouts, it is good to kind of know the overall trend, but without going to the higher time frames, because I hate, like, if I'm trying to take a 5-minute trade, I don't want to be looking at the 4-hour and the 1-hour and the 30-minute time frame. I just want to stick to the 5-minute time frame. So the way I look at the overall direction and where we're likely to go is by zooming out, and literally, if you need to, just draw yourself a little channel and just to give you that clarity, that like mental clarity, because it's all psychology, to be honest with you. But like, yeah, looking at it, you can see that the overall direction's going up, yeah, even if I was to pull it back. So at this point, you'd look and go, boom, we was in this down channel, but now price is kind of going up, yeah. So that's how I look at my overall direction, literally just like this. These channels really mean nothing, but it's more for just, if you put them there, then you get a picture, you get the idea of where we're kind of going. The only time I will use higher time frames, like the 1-hour and the 4-hour, is if I'm already in a trade. Because look, if you go on the 1-hour time frame, price is going down. So the actual direction in the trend on the 1-hour is bearish. We're going down. So let's go to the 5-minute time frame, knowing that we're fully bearish on the 1-hour time frame. Now on the 1-hour, you're looking at it and you're thinking, right, it's just a pullback. When it drops, it's gonna drop pretty hard. But we don't know how far price is gonna go up on the 5-minute time frame. So for us waiting as scalpers, we're not that patient, I don't think. Look, we'll be waiting for this to be broken or something like this, and we'll think, right, on the 1-hour it is bearish, so we're just waiting for it to break and go down. But within that amount of time, price could just skyrocket up like this. Boom. So I'm guessing, yeah, that's New York Open. New York started there. Boom. We break out to the upside. So we missed out. We would have missed out on all of this whole move as scalpers, if we were only looking to go down, because the 1-hour time frame says that it's bearish and our bias should be bearish, so we're going down. But like I just showed you, that whole move happened super bullish on the 5-minute time frame in a really bearish 1-hour market. People would look at this trend line on the 1-hour and think price is going to drop, because they've marked their overall direction up on the 1-hour and they're trading the 5-minute time frame, when in reality, boom, it just breaks the trend line, literally shits all over the trend line, and breaks structure. So this is why I don't really look at higher time frames like the hour and the 4-hour for trading 5-minute and 1-minute time frames. I just stick to the time frame I'm on. The only time I will use the higher time frames if I'm targeting like a take profit, and I'll look on the 1-hour and the 4-hour, whatever, and see where them key areas are. But yeah, for overall direction, literally just stick to what time frame you're on. So let's just look for another example. And if you guys are wondering what these purple highlighted boxes are, they're just the sessions. They're just New York sessions. If you don't know about them, you should check them out. They're by Lux Algo. And yeah, I just keep my New York sessions on for when I'm back testing. It just saves me a bit of time instead of looking for the 2:30 open. They're just there. But yeah, this is the 1-hour time frame. So say we're looking for our overall direction on a 1-hour time frame. Well, I'm not trading on the 1-hour time frame, so I know we're bullish on the 1-hour, which is cool. But any little moves like this, see this? These little moves, these little pullbacks. When I'm trading the 1-minute time frame and the 5-minute time frame, they're not little pullbacks. They're like complete trend changes. Do you know what I mean? Like, look at these moves. They look tiny on the 1-hour time frame, but in reality, these are actual trends on the 5-minute time frame. Remember now, we're super bullish on the 1-hour time frame, but then this happens, this break. Potentially, we've missed out on all of this just because we didn't want to take shorts in a super bullish trend. Do you get what I'm trying to get at now with the overall direction? So it's cool to know what's going on, but just understand if you're looking at the 1 hour time frame for your bias and you're trading the 5 minute time frame, that's cool. Just know if price pulls back on the 1 hour, then you're looking to take shorts, and it's cool to take shorts because we're trading on the 1 minute and the 5 minute time frame. So it's fine to take shorts in a bullish trend on the 1 hour, because 1 hour pullbacks are like these are massive. This is a 1 hour pullback on a 5 minute time frame. It's like a 1 to 8. Literally, if we just get out on a simple break of a trend line. My advice for this part of the video, looking for overall direction, is literally if I'm trading a 5 minute time frame, this is what I do. Pre-New York open, yeah, and I'm trading a 5 minute time frame and price is moving nicely like this. This is what I'm going to be doing. I'm literally just going to be looking and going, well, price to me now looks like it's starting to go up. And this is where I'd look for my support and my resistance, etc. But I'll get into that a bit more in the video. But right now, this overall direction bit, just keep in mind these channels really mean nothing. They're more for your own psychology and your mental view. But boom, I'm looking for breaks to the upside basically. So on New York Open, we either break down, we break up. Boom. Don't complicate it basically. If you're going to look at the 1 hour for your bias, your overall direction, your trend, whatever, understand things like NAS100 and US30 are so volatile, they're quickly changing all the time. Like, how would you even give yourself a bias or an overall direction by looking at the 1 hour time frame in this? But if you go down to the 5 minute time frame, there's trends. There's like clear trends going on. And then if you go to the 1 minute time frame, there's going to be even more clear trends. But there's opportunities for us scalpers to really profit and take money from just looking at the one time frame. Do you know what I'm saying? And just looking for them breaks. So yeah, it's good to keep in mind where price is actually going in the long run, or you think it's going, but just don't get too technical with it and start on the 4 hour, then go to the 2, then the 1, then the 30 minute, then the 15 minute, just to get the 5 minute and the 1 minute time frame for a breakout trade that you're probably going to be in 3 minutes, 1 minute, maybe 30 seconds sometimes. I'm not even joking. That's my view on overall direction and trends. Keep it simple. Look at what price is doing before the market open and what you expect it to do. Don't get too caught up in too many time frames because it's going to mash with your brain. And yeah, keep it simple. Keep it to a minimum. And yeah, that's the first part of this strategy. So now we got overall direction out the way. Let's talk about support and resistance. I'm pretty sure everybody knows by now that when price gets pushed down, then there's some sort of resistance. That's where the sellers are. That's why price is resisting to go higher. So you put your zone there. When it breaks above, people expect it to come back and retest it as support. And that's where the buyers are. Supporting price, making it go higher. So you can look at it however you want. There is obviously times we can and we should add it to our strategy. I'll show you how and why in a minute. It can be really helpful as an extra confluence. So this is how I draw my areas for a start anyway. I'm not going to put this little line and say, right, that's my resistance, that's my resistance, that's my resistance. This whole area price is resisting from. It's been pushed down 3 times as far as we can see, okay? So where would our support be? My support would be there. And also you could put a support there because price is clearly getting bounced off there too. It's had a reaction a few times there. So like the more times price reacts from an area, the more likely it's going to react from there again, whether it's above it or below it. So how do we use them? Well, boom. We've just broken straight through a support on a 1 minute time frame. And when it came back, it reacted and it came back off it again. Let me unclutter this chart. We can see price has reacted there. There, if gone above, if bounced off of it, if broke back below, if bounced from it. So this is clearly a support and resistance area. So pre-New York Open, we've got a few little areas marked up. Can mark this is our support / resistance area. This could be a low area. Remember, just be real with it. Don't draw skinny little thin lines. Actually mark them up as zones. Areas price can bounce from and react from. So we get this little pre-break before New York Open. We use our overall direction, all on a 1 minute time frame. Look, I'm saying, right, overall direction clearly going down. We got resistance on New York Open now. If we come up and we break above the resistance areas, we can buy on the breakouts. Or if we reject it and come down, we're looking for a break and we can sell. So New York opens. What they do? Came up, rejected the fucking resistance area pretty hard. Could have got in, and boom. So we're putting our overall direction and our support and resistance areas with this little break. And yeah, we're just literally going off of that. That's what we do. Comes back up. Let me guess. If we pull this down and put it there, support, resistance, boom. Bounces from it, bounces from it, bounces from it. So that's how we could have had another entry if we wanted to, or if we missed the first one or got faked out and price comes back and rejects this area again, get our second entry or our second opportunity to trade if the first one fucks up on us. So that's a good way to use support and resistance. So this is another good example. This was Friday the 27th of December. So if you was to mark this whole area where price have just bounced from twice, boom, clearly that's some sort of support, right? You drag it all the way across, and what happens when price gets back there on another session, on the next New York session actually, boom, it reacts. If it's a strong resistance area, price is more than likely going to bounce from it, and we can use it to our advantage. Literally just make it make sense. Boom, if price comes up there and taps in, it's likely that it's going to bounce from it. If price taps in but there, it's likely it's going to bounce from it, from previous sessions. So yeah, this is the whole thing of support and resistance for me. If bounced from there before, it's likely to do it again on a New York open or before. Oftentimes, price makes patterns and breaks before New York open. But look, we had this little support again. Even though it's small, price breaks, price rejects, stop loss. For you lot, you should be smart and put your stop loss always above structure. I always do it a bit tighter because I'm usually in and out. But yeah, just target in the lows and yeah, smash the first ones. Maybe smashes the second ones. I don't know. Yep. So we're going up. Nice. So now we know that. There's a resistor. There's a support. Sorry. There's a resistance. If broken through that. So now this is the next resistance. This is the next support. Price breaks through. If you're smart, you put your stop loss below structure and you look for previous highs, previous structure, etc. In this case, you could like target all of this because there's so many imbalances in moves like this. But you know, I just go for my 1 to 3s usually. But you know, if you're using a razor sharp stop loss like this, that could have been a beast. But if you actually are a beginner and you know, you're just getting into it, you should be using structure. Try not to be so ballsy yet. But yeah, I like to use really tight stop losses. I'm literally using like a 20 pip stop loss most of the time. 30 max, it depends on how price is moving. But when I see consolidation like this, I love it. When there's barely any price action at all, I love that shit because you know it's just gonna boom one way or the other. But yeah, that's basically how we're using support and resistance. Like another beautiful example right here. Price have reacted from this area. You know, this is before the New York Open. Just before, actually. 5 minutes before. Boom. Look what happened. Price touched the support. Wicked it. Leaving this lovely wick. aka liquidity sweep. And then, boom. Smashes previous structure. Like always. If you was to have got in on this, which you would have if you was using my strategy, because I'm going to explain in a bit how we capitalize from these spikes and these fake outs, that would have been a lovely trade. So my main tips for support and resistance basically is look at the previous session if you want. Mark up the areas that have bounced from, you know, reacted from. And yeah, wait for your session to kick in. See what happens then. So also another way I'm going to teach you how to use support and resistance is like this. If price likes to react from support and resistance, how else can we use it? Instead of waiting for price to get there and trading from it, we can trade into it. We can use support and resistance areas as actual targets and key levels. So let's take this as an example. This is a clear resistance area, right? And this is a clear support area. New York Open. This is a support area. You know, the price is likely to come and tap in and test it at some point. Boom. That's one trade done. Just from targeting support. Now you see a reject the support area. This is where you could go down to your 1 minute time frame, get a little sniper entry and target a 1 to 3 or, you know, whatever. But boom. So we've just used the support area as a target and somewhere to trade out of. So you can trade into it, you can trade out of it. Just got to get creative with trading. Now we know we're back at another area again, back at like resistance, whatever. What's it likely to do? React from it, give us another opportunity. Another trade again, just from using support and resistance areas. And I'll tell you right now what I'm looking for if I'm going to be trading like that is a momentum candle, an engulfing candle, or a rejection. So in this case, on support, we had a rejection. When I see a wick like this on a support or a resistance area, I really hesitate. I just get in. I'm already moving my stop loss to break even super fast as soon as I'm in. So if this is my original stop loss and I get all the way up there, my stop loss is at break even, or I'm closing out. I'm done. Because I understand that we're on a 5 minute time frame and we're in a downtrend, but I'm just catching the bounce. I'm catching the reaction from the support, and then we're back up again into another resistance, and then I go to my 1 minute time frame and I see this. I see a rejection, and I see this main thing I got my eye on is this momentum candle. That's enough for me to say, right, it's resistance, we're in a downtrend, and there's a momentum candle. I'm in. So that's pretty much how I use support and resistance anyway. Just remember to keep trading simple. Don't overdo it with things. If prices bounced from an area before, reacted, pushed down from it, it's likely to push down from it again. If prices pushed up from an area before, it's likely that it's going to push up from it again. It's not definite though, but look, this uptrend started from over there. The buyers was over there. So what does price do when it gets there? Boom. As soon as you see it reacting from this support area, just target a 1 to 2 or this level there, and you could get out. I don't know how far it's going to go. It's probably going to come back down now and be done. Yeah, exactly. You got to be in and out really fast. But you can use them to your advantage like that. Hopefully you can take something from this part of the video. Let's move on to the next. So this is like the actual juice of the strategy. This is like the main bit I need you to focus on now. The breakouts part. So we know first thing we look for in this strategy is the overall direction. Then we're looking for our support and resistance areas. Then we're looking for our breakouts on the opens. There's a lot of ways to draw patterns and stuff for these breakouts. So we're on the 1 minute time frame again. We're looking for the overall direction. Up, cool. That's all we're looking for. We're drawing our little support and resistance areas, and we're waiting for one to break. I like to draw a line as well, because when I see price push over the line, that's like my entry. When you see a momentum candle like this, there's no way. I'm already in this. As soon as it's pushing like this, I'm already in. And if it fakes me out, it's cool, because honestly, I'm waiting to see the fake out ones so I can show you how to deal with them. Cool. So sketchy. I would have been out well before price pulled back and done all of this. But a 1 to 5, that's calm. I'm alright with that. But they're not always going to be beautiful breakout trades like this on the 1 minute time frame. Trust me, you're going to get faked out a lot. Pre-New York Open, what I'm looking for is a direction. But don't be fooled, because just because we're going up doesn't mean that I think on the New York Open is going to be a buy, because it could just as easily be a sell. So we're on a 1 minute time frame. All I'm looking for before New York Open is some sort of pattern, some sort of like channel. It don't need to make sense to everybody. There don't need to be no signs to this. You're just looking for things that have been broken, like this have been broken. Okay, cool. So now we're going up. Chances are we're probably going to drop at some point. Okay, so now I put my support and my resistance. Well, this area looks like the most clear one with the most touches. Being tapped in there twice, tapped there, being tapped there, and it just keeps getting touched. So we got our support area. I'm not just going to use a skinny little thing like this, and as soon as it gets broken, I expect that to be the breakout. I'm going to be realistic with myself. Use it as a whole area. I wouldn't want to just see this bit get broken. I'd want to see this whole area get broken. And then I'd be looking for a sell. But let's just see what happens on the New York Open. It wicks it, doesn't break it. Okay, cool. When you see something, when you see this, it didn't break out of this channel. But when you see a momentum candle like this, and it breaks through, stop loss is tight. All I'm doing is targeting the bottom, or a 1 to 3. Boom. So we'd have got a 1 to 4 before coming back up and stopping us, or hitting us at break even. Like, look, I'm trying to find a bad trade for a sec, but they're just not showing. Like, honestly, these are ridiculous trades because they're real. This is what happens on the 1 minute time frame. If you're just getting in on these breaks and you're putting your stop loss there, or I'm even putting my stop loss there. I'm not even lying. I swear my stop loss is like 20 pips max. Boom. That's a 1 to 4 if you get out on the pullback. If you hold it, if you really held it, and you looked at maybe the bigger picture and see where price was overall going, this is the reality of breakout trading. 1 to 10s. So why are you going to care about losing 3-4 times in a row if you have to, and limiting yourself, mind, and calling it a day and saying, okay, it's cool, I just got faked out 4 days in a row. But the day that I didn't get faked out, and I zoomed out and I looked at a higher time frame and I looked at the key levels, etc., and I just watched price go up in my favor, I just had a 1 to 10. So you cover all your losses with this strategy, but the majority of the time the strategy works, and it works beautifully. So overall going up, you can see that I don't even need to draw the lines. Pre-New York Open, we're coming down. That's cool because I already know we're going up. If you want to drag over some support over there, that's giving me that instinct that price probably going to break to the upside on New York Open. So it breaks, you're in. It's up to you where you put your stop loss. And price just takes off. And you know what? I can honestly say to you, these trades, they ain't going to happen every day, but they happen every week. I can promise you that. So say you took a few losses, a few fake outs, but you're using the right risk management. When it does win and goes in your favor and you hit a 1 to 7 because you grew some balls and you sat there and you let the trade play, believe me when I say it's okay. Imagine this. You put in 0.5% or 1%, you put in 1% on a trade. You lose your 1% 2-3 times in a row in a week, but you hit one of these. That's okay. You just hit a 1 to 7, and it happens. As long as you stick to this plan, you gotta stick to it even when you lose. Don't just be switching strategies. Let's go to the 5 minute time frame. So we all love clean breakouts on the New York Open. We all love it, but the reality is it's not always going to be that way. And you gotta understand as well that you need to be, like, if you're trading a 5 minute time frame and you're trading breakouts, how many 5 minute candles are you trying to hold? Because if you get one big 5 minute momentum candle like this, you got your area there which you're waiting to be broken, pre-New York Open, and then you got your area there. Boom, nothing happens. You count this as a break. You get in, stop loss either down there or stop loss there. Target whatever you're targeting, right? But my point is, if you see a momentum candle like this 5 minute momentum candle, all right, so it potentially would have been a 2.5, come back though, wicked out, bam, straight back down. This is what I'm trying to say. How long do you expect to hold your trades? Because when we're breakout trading, you've got to be in and out. So if you're on a 5 minute time frame and you're holding a candle for 5 minutes and watching this momentum candle going up, down, boom, how long do you think you're going to hold it for? That's why I like trading the 1 minute time frame, because I see more structure. If I get faked out, I can get in more easy. A lot of people argue and say the 5 minute time frame is best. I use them both depending on what price is looking like on the day. But when you see rejections like this wick, and then you see a break, that 5 minute candle I would have been out. So I would have just been there, me, done. 1.83, I'd be done. But yeah, you got to know when to call it a day, yeah? So let's just keep looking, because I want some fake outs. I want to show you how I deal with fake outs. So this is what I'm going to teach you differently, I suppose, to what Mamba does. I'm going to teach you the way to deal with fake outs, because trust me when I say this strategy is easy, but it's also easy to lose a lot of money. If you ain't ready for the fake outs and ready to adapt to the markets, you're gonna lose a lot of money. So let's look for a fake out. Perfect example. So we're coming down, you can clearly see we're on our way down. So we add some support and resistance. Boom. Clear support area, clear little resistance area, just waiting for the break. Now a lot of people would have got in on this. As soon as this 1 minute candle opened on the New York Open, they'd be in. They would have been stopped out really quickly, faked out. But do you know why I say it's okay? But the beauty of it is it left the wick. So when I see a wick left like that, I rarely ever think about it. My second trade is instantly just sell. Stop loss above the wick. Target either just a 1 to 2 so you can cover your loss and get back one on top, or go for the 1 to 3s like me, or trail your stop loss and just watch where price goes. Cool. So price dropped easily to a 1 to 3 before coming back up. So that's how I would have dealt with a fake out. And this was the actual break, and we're already out. At this point, we're already out, or we've already trailed our stop loss and collected some profit. All of these examples have been on a 1 minute time frame so far. I will move to the 5 minute, but I'm showing you the 1 minute because I want to show you that's where the most fake outs happen, because it's so volatile. So this is lovely. I love seeing this. Price just doesn't know what it wants to do. This is the 5 minute time frame. It's stuck in this little, consolidation. It's beautiful. So the next candle's the New York Open. Boom. So cool. You would have entered on a sell. Now, you could have either been at break even already, because if you get in as soon as it breaks and price gets to there and your stop loss is super tight like mine, a 1 to 1, you're already at break even because you're expecting prices to just keep pushing down. So you could have been at a break even, or you could have been stopped out, which is fine, because then I explain when it pulls back like this, you look on the 1 minute, it's pulled back, it's made some structure. That's the next breakout point. And above there's the next breakout point too. So price comes up. Boom, gives us this momentum. I'm in. Stop loss tight. I get stopped at a break even again. Or I could have even lost again. Literally, I could have lost. But when you see momentum like this, that one there, that's the one. You know that if just liquidated both areas, this whole move there was just a liquidity grab because of all the build up where you've got sellers putting their stop losses all above there, and then you got buyers putting their stop losses all below this area. Big moves up and down with just a liquidity grab. Now you've come and you've broken this pullback area that you've marked up, and as soon as it breaks, you're in. Stop loss tight as fuck, literally 20 pips, if that. And yeah, honestly, this trade could have been a beast, and you'd be happy, you'd be done. So that's how we catch these beautiful breaks even after being faked out. So for me, the main change that I made to the MambaFX strategy, what I found improved it for me dramatically, was the fake outs and how to deal with fake outs. A lot of the times you're gonna get these clean breaks on the 5 minute time frame where it's just like this easy. Pre-market open, you just do something like this, or even this, wherever your preference, just waiting for breaks, clean breaks. So you could count that as a break and say, right, I'm in. Stop loss below there, target a 1 to 2 or whatever. I always explain my stop losses are ridiculously tight, but I don't expect beginners to be comfortable doing that. But I'm used to it now, and I don't mind if I take these little losses because my risk management is right. And a lot of the time you get these clean breaks. Not every time, but yeah, you do. They do happen like a lot, at least every week. Once or twice a week you get a massive, lovely clean break, which covers all the little losses. If you're using proper risk management, you're not gambling and you're not going into all sorts of other shit, but we will get into that stuff a little bit more in a bit. But let me just show you how to deal with fake outs, in my opinion. Overall direction up, cool, whatever, we've done that. So now we got our little line. We're expecting this area to be broken or this area to be broken. We get in on the breaks, yeah? Boom. So you could have entered on this, but say you did. Price goes in your favor a little bit. Wherever you could have entered there. Don't know where your stop loss would be, if you're comfortable putting it there, or, you know, you want to get a tight stop loss. So I don't know whether you would have been out at break even or not, or stopped out. But this is what happens when I see this. When I see price come down like this, and then this big candle all of a sudden comes back, I just enter, literally. And all I try and do is recover my loss and a little bit more, or maybe actually catch the right direction, depending on the momentum of the candles. So I would have recovered my loss. I explain to people all the time, this probably would have stopped out a lot of people trading with forex brokers, but with futures there's no spreads. That wouldn't have stopped me out be in this trade. It happens to me all the time. I always come pips away from being stopped out. I'm used to it. But look, the main goal of it is to get back what you lost in the beginning. So if you did enter on this breakout and it stopped you out with this lovely big bullish candle, it's cool, because we're either looking for a wick like this, like if this big wick happened there, it would have been perfect, but it didn't. Or we're looking for an engulfing candle, which literally shows us that it was a little fake out, and price came back up. And as soon as I see price come back up like this, I'm in, like I just explained. And I'm only trying to recover what I lost and a bit more, but you could catch an actual reversal. That's how you trade fake outs. But that's if you're using a 0.5%, or you're allowing yourself to take 2 trades a day. We'll get into that with risk management, but yeah, I allow myself to take 2 trades a day using a 0.5%, because if I lose the first one, then I can take a second one. And if I lose 2 trades, that means that I've lost 1% all in all. So that's my maximum daily loss limit. But if I win, I usually win, you know, anywhere between 2-3%. So I get big trades, 1 to 4s, 1 to 3s. Another perfect example, right? So pre-market open, we've got our lines, support, resistance, whatever. We're expecting one of them to break. Now, if you think price was going to come down, you could have got in, been faked out, maybe break even. It depends how rapid you move your stop loss. But whatever, it went against you. But what did it leave? It left this wick. I'm telling you, as soon as I see these wicks, I'm in. As soon as the candle closes, I'm in. And all I'm trying to do is get back what I lost, and maybe one more. And there it is. I would have already been out. So I would have lost my one, but just got back what I lost and one on top. Do you know what I'm saying? And maybe even caught the actual direction of the trend. You don't know. This could have been a 1 to 3. But that's how I look up fake outs and breakouts. Pre-New York open. Boom. You could think that's a breakout. What's it do? Leaves a wick, aka liquidity. Next candle is a big boy. Boom. Do you see what I'm saying about just if you get faked out because you got in on that break and it reverses on you, just flip your position, adapt to the market, try and get back what you lost, or target structure that makes sense. And this is how you catch these. So being faked out is absolutely fine. Like, being faked out actually is part of my strategy. When I get faked out, it's like, cool. I'm not scared, because I told you I got my 2 trades a day rule, so it's okay. I got faked out, whatever. If I got faked out and I break even, or faked out and I actually lost the trade, I don't care. Take the second trade, and it usually goes in my favor. And if it doesn't go in my favor, then I'm done for the day. I took 2 losses that adds up to a 1% loss. And then when I win and hit those 1 to 3s, 1 to 4s, 1 to 2s, whatever, the win rate's gonna carry you. Not the win rate, sorry. Your wins are gonna carry you over your losses. Like, look at this shit there. I don't make this up. This is past price action, but we're breakout traders. So I explain to you all the time, we're looking for the overall direction, and then we're looking for breaks, patterns, whatever it is that makes you get in that trade. Boom. Honestly, it's ridiculous. Like, this happens. I'm not drawing these on the charts myself. This literally happens for us breakout traders. That's what makes it all worth it. When you do catch these 1 to 9s, it's frustrating when we get faked out. It happens all the time. It happens to me every single week. I probably get faked out more using this strategy than I do just get a clean breakout and it goes in my favor. But I usually end the day profitable anyway, even after a fake out, even after 2 fake outs. Because if they're hitting me on break evens, I'm not counting those as losses. I can take 2 L's in a day. But if I take one nice decent win, I'm off. I'm done. But we'll talk about that in risk management. So even though I was just covering breakouts and fakeouts, I don't think I actually went into entries, my entry work. Do I enter straight away as soon as it breaks, or do I wait for the candle close, etc.? So for me personally, I would be entering as soon as it breaks. I'm entering on momentum. I don't want the candle to close because that means I could have lost a whole lot of pips. But it needs to break something though. Let me be clear. It needs to break a line or support or resistance. So let's take a look at this one. Put my line there. But remember, I'm taking into consideration the whole area as a resistance area. Then I'll be taking this push up as my support. Whichever one breaks. Whichever one breaks first with momentum, I'm getting in. Yeah, I'd be in on that. Not gonna lie. Targeting 1 to 2 minimum. But then you got all of this that you could target as well. All I know is I'd be in. 35 minutes, I'm done. I'm out. Boom. Get me out of here. So yeah, I'm entering on the breaks. And that's where I get faked out a lot. Because, you know, sometimes it just leaves a wick, which is cool because then I'll enter the opposite way, like I explained. So I've basically taken you through everything that I know about this strategy and tried keeping it as simple as I can and make it easy enough for all of you to be able to follow. But we do need to talk about risk management. So risk management for me goes like this. I'm risking 0.5% of my account and I use a futures account. So say I take a 50k combine, then a 0.5% would be £250 or $250, right? You've all heard the 1% rule or the 0.5% rule that I just explained. Well, you need to listen to it because unless you're flipping a small account, you're going to need to risk more. If you've got $100 and you want to turn it into $1,000, then you're going to need to be risking at least $10 to $20 per trade with a 500 times plus leverage account. Simple. If you want to flip a small account fast. That's the truth. You need to be risking more. But if you've got a big account or a prop firm challenge or you're funded, then you should be risking 0.5 to 1% max. So if I was to risk 1% per trade, I take 1 trade per day. And if I get faked out or I lose, then I'm done. If I lose 1% in a day, I have to be done. But that's why I use 0.5% so I can trade twice. So basically, if I get faked out and I lose the first trade, I can take another one, try and recover from it and gain some profit. But, you know, I move my stop loss to break even pretty quick. But as I always explain, I'm trading futures and there's no spreads, so I can afford to do that. Some people, though, trading forex, when you press buy, you got a little bit of drawdown instantly because of your spreads. That's why you need to go and choose brokers with really low spreads. You just need to be careful. But when it comes to risk management, just be smart. Set yourself rules and stick to the rules because you're the only one holding yourself back. If you say, I'm going to risk 0.5% each trade, and if I lose twice, I'm done. But then you keep trading, you're revenge trading, and it sucks, I know, because as scalpers, we either win quick or we lose quick. But you have to know when to call it a day. And the quicker you try and get to where you want to be, the longer it's going to take. Take that in. You need to take your time. Honestly, take what the market gives you. We're breakout traders. So if you're trading 5-minute time frame and the 5-minute candle's super bullish with momentum, you either move your stop loss to break even really quick and accept it. If it comes back, you just got taken out of break even. It's fine. It's up to you if you want to re-enter, but I'd say know when to take the money to and be happy, because when one bullish candle gives you like 20 to 40 pips in 5 minutes, be happy with that. That's why I'm talking about how much money you have to play with, etc. Also, there's a little saying called reset, restart, and refocus. That is so key when it comes to trading. Every day, you need to reset your mind by getting off the charts. You need to restart by waking up in the morning, getting ready for the day, and you need to refocus, because otherwise you're just going to hold yourself back. I was doing it to myself for years. I was just constantly trying to get back what I was losing in the same day. I was over trading. Now I stick to my 2 trades a day rule using 0.5 only because I take funded challenges and that's how I make my money. I actually don't really use my own capital unless I'm flipping small accounts and using super high leverage. But yeah, I hope this video helped, and I'm going to keep dropping knowledge anyway. And if my trading strategy adapts and I learn new things, then I'm going to keep posting. So yeah, make sure you sub up and you like and you never miss a video.